Alright, folks, welcome back to Boss Economics World, the only channel that peels back the jargon-filled onion of the global economy to show you the crying shame at its core. Today, we're diving into the latest dispatch from the ivory tower of monetary policy, the Federal Reserve. It's September 26, 2025, and the high priests of the dollar are, once again, giving us a masterclass in what I like to call strategic confusion. The man of the hour is Austan Goolsbee, the Chicago Fed president. Now, Goolsbee is an interesting character. He's an academic, a former Obama guy, and he's trying to play the role of the sensible adult in a room that's starting to look like a political food fight. He came out yesterday with a statement that, on the surface, sounds like prudent central banker talk. He's uneasy with too much front-loading of rate cuts. He wants to be convinced that the recent pop in inflation is transitory. Transitory. Oh, that word. That beautiful, discredited, ghost of a word. The last time the Fed fell in love with transitory was back in 2021. They whispered it like a sweet nothing while inflation was silently picking the economy's pocket. They told us it was just a little hiccup from supply chains. What happened next? The Consumer Price Index went on a moon mission, peaking at a blistering 9.1% in June of 2022, a 40-year high. The Fed, caught completely flat-footed, had to slam on the monetary brakes so hard it nearly sent the entire economy through the windshield, cranking rates from 0 to over 5% in the blink of an eye. So when a Fed official, 4.5 years after that debacle, starts using the T word again, you, my astute viewers, should do what any seasoned investor does, check your wallet and look for the exit. Goolsbee's caution isn't just caution, it's institutional PTSD. The ghost of 2021 haunts the halls of the Eccles building. They are terrified of getting it wrong again, of being the ones who let the inflation dragon out of its cage for a second time. But this isn't just about Goolsbee's personal anxieties. This is the first crack in the facade of a major policy war brewing inside the Federal. Let's break down the battlefield. On one side, you have the Goolsbee camp, the institutionalists, the data dependents. They look at the numbers. And what are the numbers telling them in September 2025? Well, let's paint the picture. After the brutal rate hikes of 2022 to 2023, the Fed managed to wrestle inflation down. Core PCE, their favorite little metric, had a beautiful journey south, touching a respectable 2.5% by the end of 2024. The markets cheered, the soft landing narrative was cemented, and the Fed even delivered a victory rate cut last week, the first one since December 2024. But, and there's always a but, a new gremlin has appeared. Goolsbee explicitly names it, tariffs. Thanks to the Trade Security and Domestic Production Act of 2025, we've seen a fresh wave of tariffs slapped on everything from European auto parts to Southeast Asian semiconductors. And surprise, surprise. When you tax imports, things get more expensive. Core PCE has now ticked back up to 3.2% in the latest reading. The headline CPI, which is more sensitive to volatile goods, is back near 4%. So Goolsbee is looking at this and saying, whoa, hold on. We're trying to put out a fire here, and the fiscal and trade guys are spraying it with gasoline. Cutting rates aggressively right now would be insane. He's absolutely right from a pure economic theory standpoint. But on the other side of the battlefield, you have the new guy, Governor Stephen Miron. Appointed by President Trump, Miron isn't playing the same game. He's not an institutionalist, he's a political operative with an economics degree. He's advocating for a series of half-point cuts to protect the labor market. Let's translate that for you. Protect the labor market is the new political code for juice the economy, and fast. Miron sees a different set of data. He sees the Atlanta Fed's GDP Now tracker blinking a rather anemic 0.8% for Q3. He sees that while the headline unemployment rate is low, the U6 rate, which includes the underemployed, has been creeping up. He's arguing the Fed is overly restrictive. But the real game here is political. We are heading into the back half of a presidential term. The pressure is on to get the economy roaring. A central banker appointed by a president who famously tweeted his displeasure with rate hikes is going to be incredibly sensitive to any signs of economic weakness. Miron is the political will of the executive branch personified, sitting right there at the FOMC table. His mandate isn't just price stability and full employment, it's getting the right people re-elected. So we have a fundamental schism. Goolsbee is trying to solve a 2022 inflation problem. Miron is trying to solve a 2028 election problem. They are using the same tools to fight two completely different wars. This is a recipe for disaster. This brings us to the core issue Goolsbee flags as the biggest risk, the emergence of stagflationary conditions. For our viewers who weren't trading bonds in the 1970s, let me break down this beast. Stagflation is the economic equivalent of being sick and broke at the same time. The stag comes from stagnation, meaning the economy isn't growing. GDP is flat or falling. Businesses aren't investing. People are losing their jobs. The flat ion comes from inflation, meaning prices are still rising. Your rent goes up, your grocery bill goes up, but your paycheck doesn't. It's the worst of all possible worlds. Why is this the Fed's ultimate nightmare? Because their two primary tools are designed for opposite problems. To fight inflation, you raise interest rates. This cools down the economy, slows spending, and ideally, brings prices down. To fight stagnation, you cut interest rates. This stimulates the economy, encourages borrowing and spending, and gets things growing again. So what do you do when you have both at the same time? You are utterly, completely trapped. If you raise rates to fight inflation, you crush the already stagnant economy into a deep recession. If you cut rates to boost the economy, you pour fuel on the inflation fire. You have one pedal that's the brake and one that's the accelerator, and the economy is demanding you press both to the floor simultaneously. And this, ladies and gentlemen, is precisely the trap being set by tariff policy. Goolsbee makes an incredibly sharp point that most of the talking heads on cable news will miss. He says that because of tariff-driven inflation, holding rates steady has the same effect as cutting rates. Think about that. He's talking about the real interest rate. The real rate is your nominal interest rate minus the inflation rate. Let's use some numbers. Say the Fed funds rate is 4.5%. If inflation is 2%, your real interest rate is a restrictive plus 2.5%. But if tariffs push inflation up to 4%, your real interest rate is suddenly a much less restrictive plus 0.5%. By doing nothing, the Fed's policy stance has become more accommodative. The tariffs are doing Miran's work for him, but in the worst possible way. They are stimulating inflation without stimulating any productive growth. This is a classic supply-side shock. Remember the oil embargoes of the 1970s? The price of a fundamental economic input skyrocketed, causing prices across the board to rise while simultaneously choking off economic activity. Today, semiconductors, industrial components, and consumer goods are the new oil. Tariffs are an artificial, self-inflicted supply shock. The Federal Reserve is being asked to clean up a mess created by trade policy. That's like asking a heart surgeon to fix a broken leg. They might be a brilliant doctor, but they have the wrong tools for the job. Let's zoom out from the he said, she said of the FOMC meeting. The real story here, the one that will define the next decade of American economic life, is the erosion of the Federal Reserve's credibility and independence. 1. The credibility deficit. As we discussed, the transitory call of 2021 was a body blow to the Fed's reputation. It shattered the public's belief that these experts knew what they were doing. For markets to function, they need a credible anchor for inflation expectations. They need to believe that the central bank will do whatever it takes to keep inflation at its 2% target. When that belief wavers, businesses and consumers start acting as if high inflation is permanent. Workers demand higher wages, and businesses raise prices to protect their margins, creating a vicious wage price spiral. Goolsbee's hesitation is a desperate attempt to rebuild that shattered credibility. He knows that if they cut rates now and inflation runs hot again, the market will simply stop believing anything they say. 2. The political onslaught. The appointment of an openly political advocate like Miran is a symptom of a deeper disease, the relentless politicization of the central bank. Historically, the Fed's greatest strength was its perceived independence from the whims of short-term politics. This allowed it to make unpopular but necessary decisions, like Paul Volcker did in the early 1980s when he hiked rates to nearly 20% to break the back of stagflation. It caused a brutal recession, but it worked. Could a Fed in 2025, with a Governor Miran at the table and a president live tweeting every FOMC meeting, ever make a Volcker-like decision? I have serious doubts. The pressure to prioritize the short-term political cycle over long-term economic stability is immense. When the central bank becomes just another arm of the Treasury or the White House, it loses its power to anchor inflation. Look at countries where this has happened: Turkey, Argentina. You see chronic, debilitating inflation and economic instability. We are not there yet, but the warning signs are flashing red. So, where do we go from here? As I see it, there are 3 possible paths forward, and none of them are particularly smooth. Scenario A, the Goolsbee gamble. The institutionalists win the day. The Fed holds rates higher for longer, maybe delivering just one more token quarter-point cut by year-end. They stare down the political pressure from the White House. Their goal is to wait out the tariff-induced inflation spike, praying it's a one-off event and that the underlying disinflationary trend resumes. The risk? They miscalculate. The economy is weaker than they think, and holding rates high pushes a fragile economy into a recession anyway. They'll be blamed for killing the recovery right before an election cycle. Scenario B, the Miran mayhem. The political wing of the Fed gains control. They push through the series of aggressive 50 basis point cuts Miran is calling for. The market rips higher on the cheap money. We get a short-term economic boom. GDP numbers look great for a couple of quarters. The administration takes a victory lap. The risk? With the supply side constrained by tariffs, this flood of new demand sends inflation into the stratosphere. We're not talking 4%, we're talking 6% or 7% by mid-2026. This forces the next Fed, perhaps under a different administration, to slam on the brakes even harder than they did in 2022, triggering a much deeper and more painful recession. This is the classic boom and bust cycle, engineered for political gain. Scenario C, the stagflation swamp. This is the most insidious scenario. The Fed splits the difference. They deliver a few timid rate cuts to appease the politicians, but not enough to truly stimulate the economy. Meanwhile, the tariffs keep cost-push inflation stubbornly high. The result is an economy that's stuck in first gear, 1% growth, 4% inflation, and a slowly rising unemployment rate. There's no major crash, but there's no prosperity either. It's a slow, grinding decay of purchasing power and economic dynamism. This is the Japan of the 1990s meets the America of the 1970s. So, what are we, the viewers of Boss Economics World, to make of all this? Austan Goolsbee's comments are more than just a press release. They are a distress flare from the engine room of the U.S. economy. They reveal a central bank at war with itself, haunted by its past mistakes, and trapped by the political realities of the present. They are being forced to navigate a minefield created by fiscal and trade policy, and they are arguing about whether to use a map from 1978 or a GPS programmed by politicians. The optimistic case Goolsbee mentions, a soft landing with full employment and stable prices, is still possible. But the window for that perfect landing is getting smaller every single day. The crosswinds of tariff inflation and political pressure are getting stronger. Your job isn't to cheer for Goolsbee or Miran. Your job is to understand the game being played. The real battle isn't about 25 or 50 basis points. It's a battle for the soul of the Federal Reserve and the future credibility of the US dollar. So stay sharp, watch the data, and understand the motivations behind the headlines. Because in this theater of the absurd, the price of admission is your financial future. This is Boss Economics World. Stay informed. Stay ahead.